Next, we have payment. You already know the definition of a payment. In the context of time value of money, we're referring to those equal-sized recurring cash flows. In real life, you pay rent, you pay off your phone, car payments can be monthly, insurance premiums are typically paid every 6 months. What is useful is being able to look at a loan and knowing how to calculate the size of a payment. This will help you evaluate whether a purchase you want to finance is going to fit within your budget. Let's jump back into Excel to apply this. A manufacturing company wants to purchase new equipment to improve its production line. The equipment costs $150,000 and the company plans to finance it with a 5-year loan at an annual interest rate of 6% compounded monthly. The company will make monthly payments to repay the loan. So what is the size of that payment? Well, we can type in our annual interest rate, 6%, and we know it's a 5-year loan. But you can already tell that since we're working with monthly payments, we are going to have to adjust these once we're working with our payment function. When dealing with a fully amortizing loan, the present value is that initial outstanding balance that we incur in the beginning. In this case, $150,000, corresponding to the cost of that equipment. And the future value should always equal 0 for fully amortizing loans. At the end of the loan, there should no longer be an outstanding balance. We can then calculate the payment by typing equals PMT, open parenthesis. Now, I realize that I haven't given you an example of this yet, but you're familiar with all these parameters. I want you to pause the video now and try to get the answer on your own. Just remember to take into account the fact that these are monthly payments. Okay, so we'll take our annual rate, divide it by 12. We'll take our number of periods and multiply it by 12. Present value, future value, comma 0. And there we go. The interpretation here is pretty straightforward. This is how much we will need to give the bank each month to pay off the loan in 5 years. Let's do this again, but within a personal finance context. You are planning to purchase a townhome for $400,000. You have a down payment of $80,000, which means you need to finance the remaining $320,000 with a mortgage. The bank offers you a 30-year fixed rate mortgage with an annual interest rate of 6.5% compounded at the end of each month. So, what will your monthly mortgage payment be? We're quickly becoming experts here. Let's see how fast we can do this. Our rate, I'm going to do 0.065. Number of periods, it's a 30-year mortgage. Now the present value, we have a couple of big numbers here. The purchase price is $400,000, but the actual amount of the loan that we're going to pay off is this $320,000 mortgage. And with a fully amortizing loan, future value is 0. Equals payment. Remember, we'll take this rate, divide it by 12 because it's compounded monthly. We'll multiply the number of periods by 12. It's a 30-year loan, but it's going to be 30 times 12, 360 months worth of payments. Here's our present value and future value. And here is our mortgage. Okay, are you ready to try this one more time? This time in payment 3, I actually want you to consider a home you want to purchase in the near future. I know the housing market has been kind of depressing of late. I'm with you. I'm one of those unlucky people that, finally participated in the housing market once prices ramped up after the pandemic, but also after the Fed increased rates to 20-year highs. The fact of the matter is, home ownership is still going to be one of the most important ways to build wealth right now. So I'd like you to at least practice thinking about this process. I've got a link to Zillow off to the right here. Find yourself a house you'd consider buying. And who knows, maybe some of you watching this video are already homeowners. In that case, find yourself a dream home to purchase. Enter the listing price here. I'm just going to make up a $500,000 balance. Next, indicate any money you might be able to put towards a down payment right here. I'll put $15,000. Certainly not 20%, but it's a start. Lastly, type in a reasonable 30-year interest rate on a fixed mortgage. You can find today's average on this Freddie Mac link I've put to the side here. I'm going to put 6.5%. Once you type in these parameters, the formulas I've constructed will automatically update to show you the combined principal and interest components of your expected mortgage payment. So please, I invite you to take this seriously and try it out. We'll be referring to these numbers in the next video.